Welcome to London Property Digest, your essential 10-minute audio recap for staying informed on London's property market. We've got some interesting articles and research on the commercial side of things today. Seems like London's bouncing back in a big way after that post-pandemic slump. But there are some pretty fascinating forces at play.
Definitely. We're seeing a bit of a tug of war, wouldn't you say?
Yeah.
Rising building costs on one side, and then this whole evolution of what tenants want on the other.
Yeah.
It makes you wonder who's going to win this game of real estate limbo.
Well, the good news is deals are happening. UK commercial properties saw a 26% jump in deals during the second quarter of 2024, which actually puts it ahead of both France and Germany. Got to love a little healthy competition, right?
Absolutely. And it's not just local players. There's a definite buzz about London among global investors, too. We're seeing a lot of interest from the Middle East, Asia, and even Australia. It seems the UK, particularly London, is viewed as a stable and potentially very lucrative bet.
Okay, so big money is flowing back in. But is everything sunshine and roses? Because I've got this article here about a City of London tower nicknamed the Can of Ham, 21 stories tall, and it just sold for $322 million. Sounds impressive, but that's actually less than its asking price back in 2022.
Ah, the Can of Ham. Quite the memorable moniker. And yeah, it's an interesting case. This could be a signal for the market that while things are picking up, we're not quite back to pre-pandemic pricing power just yet.
So maybe a little wiggle room for savvy buyers.
Potentially. It'll be interesting to see if this pattern continues. Speaking of pricing adjustments, Brookfield's City Point Tower is another one to watch. They've dropped their asking price quite significantly, down to $500 million. That's a big signal coming from such a major player.
It does make you wonder what they know that we don't. But, while some buildings are struggling to hit those pre-pandemic price tags, there's this other trend emerging that's all about, luxury.
Yes. This is where things get really interesting. Take 40 Leadenhall Street, for example. It seems developers are pulling out all the stops to woo tenants. Right.
We're talking saunas.
Oh, wow.
Treatment rooms.
Wow.
Even a cinema. It's like they're trying to create a whole lifestyle experience, not just a workspace.
It's almost like they're saying, hey, we know the office isn't the only place you could be working.
Right.
So we're going to make it the place you want to be.
Right. It's a fascinating strategy. And 40 Leadenhall seems to be proving it works. It's over 80% let already. But this raises some interesting questions. Can this level of luxury become the new normal? Or is it just a temporary tactic to lure tenants back to the office? And is it sustainable in the long run, considering the rising cost of construction?
Well, that's a great point. The article here from Turner & Townsend says that building prime offices in London now costs over £500 per square foot.
Yeah.
That's up from less than £400 before the pandemic. Ouch. It is a big jump, and it's driven by a few things. Inflation is obviously a factor, but there's also this increasing demand for those high-end features we were just talking about. Developers are essentially in an amenities arms race. They're betting that these perks will justify higher rents.
So will it work? I mean, I love the idea of a sauna in the office, but will businesses really bite? Especially since we're still seeing office sales lagging behind other sectors in the commercial market.
It's a gamble, that's for sure. While the overall UK commercial property market is recovering, office sales haven't quite caught up. It makes you wonder if there's a deeper shift in how we view workspaces post-pandemic.
Especially when you look at the rising office vacancy rates in London. This article on Canary Wharf mentions it's hitting 10.1% in the third quarter. That's the highest it's been in over 20 years. And they're even talking about converting some of these spaces into hotels.
It's definitely something to keep an eye on. High vacancy rates can put pressure on rents and property values, so finding creative solutions like repurposing office spaces is key. But here's the thing. Despite these challenges, some experts are actually pretty optimistic about the office market.
Okay.
Schroders, for example, sees it as more of an opportunity than a risk.
Really? Why so optimistic?
Well, their view is that the pendulum has swung too far in terms of the doom and gloom pronouncements about the death of the office. They're betting that high-quality office spaces in prime locations will continue to be in demand, even in a world of hybrid work.
So they're saying reports of the office's demise have been greatly exaggerated.
Exactly. And their actions back that up. They're developing a massive 63-story tower at 55 Bishopsgate and are already in talks with potential tenants. That's a big vote of confidence in the future of London offices.
It definitely challenges the narrative that everyone's going fully remote and offices are going extinct.
It does. But it's also important to remember that the office is evolving. The days of rows of cubicles might be fading. But the need for collaborative and inspiring spaces hasn't gone away. And that's where these luxury amenities at prime locations come into play.
So it's less about the office dying and more about it adapting to the times.
Precisely. And those who can adapt and innovate will be the ones who thrive in this new era of the office.
Well, I certainly wouldn't bet against London. The city has a knack for reinvention. But there's one thing that is certain. Building costs are going up. And that's a trend that can't be ignored. This report from Turner and Townsend really dives into the details.
It's worth taking a closer look at that. The cost of construction is a major factor affecting not just offices, but the entire commercial property market. We've already touched on it briefly, but let's unpack it a bit further.
Okay, let's do that. What's driving these rising costs?
Well, as we've seen, inflation is playing a part. The cost of materials, labor, everything is going up. But on top of that, there are some London-specific factors at play.
Wait.
Well, London is a global hub, which means there's always a high demand for construction projects. That high demand, coupled with a limited supply of labor and materials, drives prices up. It's classic supply and demand at work.
And I'm guessing London's strict building codes and regulations don't help keep costs down either?
You're absolutely right. Those regulations are important for safety and quality, but they do add another layer of complexity and expense to any project. So it's this combination of factors: inflation, high demand, strict regulations. That's making it increasingly expensive to build in London.
And this, of course, impacts developers and investors in a big way.
Definitely. For developers, rising costs squeeze profit margins. They have to make tough decisions like finding ways to control costs or increasing rents to stay profitable. It's a balancing act. And for investors, it means they need to be extra careful about which projects they choose to back.
So thorough due diligence is more important than ever.
Absolutely. The rising cost of construction adds a whole new layer of complexity to any investment decision. It's not just about the potential return anymore. It's also about carefully evaluating the risks associated with those rising costs. When interest rates rise, borrowing becomes more expensive, and lenders naturally get a bit more cautious. It's all about balancing risk and reward.
So it's a bit of a seesaw. When rates go up, lending can slow down.
Exactly. And the overall economic climate plays a huge role, too. When the economy is strong and growing lenders are more confident, they're more willing to open up their wallets. But if things get shaky or uncertain, they tend to pull back and tighten their lending criteria.
Makes sense. They don't want to get caught out if the market takes a downturn.
Right. And then there are other factors that come into play, like the specific type of property, its location, the developer's track record, and the financial strength of the investor seeking the loan.
So it's a pretty thorough evaluation process. It's not just about having a good idea. You need to tick all the boxes.
Definitely lenders are looking at the whole picture before they decide to hand over the cash. But it's not just traditional banks anymore. One of the big trends we're seeing is the rise of non-bank lenders in the commercial property market.
Oh, interesting. Who are these new players?
We're talking about private equity firms, hedge funds, debt funds. They're becoming more and more active in this space.
Why this sudden interest from these non-traditional lenders?
Well, they're often more comfortable taking on a bit more risk than traditional banks, and that can be a good thing for borrowers who might not fit the strict criteria of a bank loan. These alternative lenders can provide funding for projects that banks might shy away from.
So they're filling a gap in the market, providing more options for developers and investors.
Exactly. They're bringing fresh capital and a different perspective to the table, which can be very beneficial for the overall health of the market. And speaking of trends, another one that's gaining momentum is green financing.
Okay, I've heard that term thrown around.
Sure.
Can you break it down for us?
Sure. Green financing is essentially funding that's specifically targeted towards projects with positive environmental or social impacts.
So it's about aligning investments with sustainability goals.
Precisely. It's about making sure that your money is going towards projects that are not only financially sound, but also benefit the environment and society as a whole. And this is something that's becoming increasingly important for both lenders and borrowers.
So it's not just about making a profit, it's about making a positive impact.
Exactly. People are becoming more conscious of where their money is going, and they want to support businesses and projects that are making a difference. And on the lender side, they're realizing that green projects often carry less risk because they're addressing pressing global challenges.
So it's a win-win situation for everyone involved.
It really is. And this trend towards green financing is only going to grow in the coming years. As awareness of environmental and social issues continues to rise, we can expect to see even more demand for these types of investments.
Okay, so we've covered a lot of ground today, talking about the trends shaping London's commercial property market. But before we wrap up, let's step back and consider the big picture. What's the overall outlook for the market, and what are some key takeaways for investors?
The London commercial property market is a dynamic and ever-changing landscape. It's influenced by a complex web of factors both local and global. It's not an easy market to analyze, but that's part of what makes it so exciting.
It definitely keeps things interesting. But despite the complexities, are you saying the outlook for the market is positive overall?
Yes, I believe so. London has this unique combination of qualities that make it incredibly attractive to both businesses and investors. It's a global powerhouse, a financial hub, a center for innovation and creativity.
And let's not forget the culture and lifestyle. London is a city that draws people in from all over the world.
Exactly. And those qualities aren't going away anytime soon. Yes, there are challenges like those Brexit uncertainties and the rising cost of construction, but London has a remarkable ability to adapt and overcome obstacles.
It's a resilient city, that's for sure. So for investors, is London still the place to be?
Absolutely. The long-term fundamentals of the market remain incredibly strong. There's a constant flow of capital from all corners of the globe attracted by London's stability, transparency, and that undeniable global appeal.
So it's a market with huge potential for those who are willing to take the plunge.
It is. But as with any investment, careful consideration and due diligence are absolutely crucial. This is not a market for the faint of heart or those looking for a quick buck. It requires a strategic approach, a willingness to ride out the inevitable ups and downs, and a deep understanding of the market's nuances.
What are some key takeaways for investors who are considering dipping their toes into the London commercial property market?
Well, first and foremost, do your research. Understand the specific dynamics of the London market. What drives it? What are the risks? What are the opportunities? Don't just assume that what worked in other markets will automatically work in London. It's a unique beast.
Yes, so knowledge is power, as they say.
Yeah, exactly. And you need a clear, well-defined investment strategy. What are your goals? Are you looking for long-term capital appreciation, steady rental income, or a blend of both? What's your risk tolerance? And what type of property aligns with your overall investment philosophy?
So have a plan, know your goals, and don't deviate from your strategy just because something shiny catches your eye.
That's great advice. And finally, don't underestimate the value of seeking expert advice. A good real estate agent who understands the London market can be an invaluable resource. They can help you identify opportunities, navigate the legal and regulatory landscape, and negotiate favorable deals. And a financial advisor can help you structure your investment in a way that minimizes risk and maximizes returns.
So it's about assembling a team of trusted professionals who can guide you through the process.
Precisely. Investing in London's commercial property market can be a rewarding and lucrative endeavor, but it's not something to be undertaken lightly. With the right approach, the right team, and a bit of patience, investors can tap into the immense potential of this dynamic and exciting market.
Those are some fantastic resources for anyone who wants to dig deeper into the London property market. And I second that recommendation for London Property Digest. We try to make this complex world a little easier to understand.
Definitely. Knowledge is key in any market, but especially one as nuanced as this.
Well, I think we've covered a ton of ground today, from those big trends shaping the market to specific sectors like offices, industrial, even retail getting a revamp. I feel like our listener has got a solid foundation for understanding what's going on in London commercial property right now.
I hope so. It's a fascinating landscape full of opportunity, but it definitely pays to be informed and strategic.
Couldn't agree more. So as we wrap up, any final words of wisdom for someone who's listening and thinking, okay, maybe London property IS for me,
Yeah.
what should I really keep in mind?
I'd say the biggest thing is to remember that this market is constantly on the move. What's true today might be outdated tomorrow. So stay curious, keep learning, and don't hesitate to reach out to experts when you need guidance.
Words to live by. Flexibility and knowledge are key. And on that note, I think it's time to bring this deep dive into London's commercial property market to a close. Thank you so much for sharing your expertise with us today.
It's been a pleasure. London property is a passion of mine, so always happy to chat about it.
And to our listener, thanks for joining us on this journey. We hope you found it insightful and, dare I say, enjoyable.
Don't forget to subscribe to London Property Digest for the latest updates.
On the London property market.
Until next time, happy investing.